Welcome back, investors. Jake here. In this video, I want to talk about an unusual problem that I think investors have in the market right now. When we check in with all the indexes, it's looking pretty red. S&P down 2.4, NASDAQ down 2.8, Dow Jones down 1.6. The obvious explanation for why the market is red today is Apple and Amazon both gave their earnings report after the bell yesterday. Apple's actually doing pretty well, only down 2% as of the time I'm recording this. However, Amazon completely decimated, down 13%. It's fallen to this nice round number of 2,500. That's where large funds have set their buy limit orders. Another piece of news that is putting selling pressure is Elon Musk sold around $8.4 billion worth of Tesla stock in order to, fund his private purchase of Twitter. So you'll see on the Tesla chart, we've got some large red candles. That might have been Elon Musk selling $8 billion worth of Tesla. Because Tesla is now a $1 trillion company, it's weighted heavily on the indexes. So if Tesla goes down, basically the whole market goes down as well. So let's first talk about Apple, because that one is a little bit easier to cover, and then we'll get to Amazon, and then we'll talk about what I think is going on with the market today. So Apple beats on earnings and beats on revenue, so top line revenue, bottom line net income, and you can see that their revenue year over year is 8.6%. For the world's largest company to still be growing year over year at 8.6%, that's still pretty impressive. Now, the headlines that gave pause for investors is Apple shares dip after company warns of a possible $8 billion hit from supply constraints. Apple no longer gives guidance because since COVID, they said it's just too unpredictable to give guidance. However, with my own personal data points and experience, I ordered a new M1 chip MacBook Pro. This was 6 weeks ago. They told me it'd be 5 weeks for delivery. 5 weeks came and went, and then they told me it would be another 5 weeks before my MacBook Pro could ship. So 10 weeks for a delivery of a MacBook Pro. I can't be the only Apple customer who's experiencing this. The COVID shutdowns currently happening in China. That's the explanation, as well as other supply chain constraints. Good news is they are authorizing a $90 billion share buyback program, or about 2 Twitters. So that's good for price support for the stock. When we pull up their earnings statements, all you need to really look at to see how fantastic this company is and what the bull argument remaining on it is, despite only single-digit year-over-year growth. Look at their net sales for products. So in the first quarter of last year, they did $72.6 billion in revenue sales, and then this year they did 77.4. But what was the additional cost of those sales? So we went from 46.4 to 49.2. So when you do the math, for an additional $3 billion in spending by the company, they were able to generate an additional $5 billion in revenue. You spend 3, you get 5. That's pretty decent. But what has investors excited is their services. This is iTunes, the App Store, and other products and services. So their revenue increased from 16.9 billion to 19.8. So this is, $3 billion in additional revenue under their services division. But how much did they spend to earn that additional $3 billion? Their costs went from $5 billion to 5.4. So spending $400 million to make an additional $3 billion, really high margins, really good return. That's pretty exciting for Apple. Now, their price to earnings is pretty rich. When we go to macrotrends.net, this hasn't updated yet, but we're in the mid-20s, mid to high 20s. During the COVID pump up of all the mega caps, it went as high as 34. And traditionally, Apple has traded in the 10 to 20 range. Their growth is probably going to be single digits for the next couple years. But if Apple can surprise everyone with a fantastic new product, Apple Car, Apple whatever, I think that can get investors excited. You can make the bull arguments. I think Apple's doing pretty fine. So when we look at the charts and the technicals, this is pretty fascinating, but I've drawn in this longer slope trend line that goes all the way back to May of 2019. So Apple has been maintaining this trajectory. Anytime it gets too far ahead of it, Apple just trades sideways until it bumps up against this line. So if the entire market sells off, it's a complete disaster. I think Apple is experiencing price supports. Buyers would step in easily at around 150. There's probably another level of support going back right here at 145. However, on the upside, I think this level of resistance at 180 is going to probably stick with us for the rest of the year. I think the next couple quarters, just in general with the economy and the slowdown, it's not going to have investors being too excited. I don't see Apple being able to break through this level of 180 probably for the rest of the year. So more than likely, Apple is just range bound between 150 and 180. It's just going to bounce back and forth. Let's get on to Amazon because this is what's dragging down the market today. Amazon shares fall on bleak forecast and slowest growth since the dot-com bust. Now, they completely whiffed on their earnings because the company recorded a $7.6 billion loss on its investment in the electric vehicle maker Rivian. This went public basically at the peak of the market in November of last year, and the share price has fallen since its IPO 75%. And I didn't make a video about it at the time. I just didn't understand why a company that hadn't sold a car yet was getting a $100 billion market cap valuation. But in general, guys, with the hysteria of electric vehicles, who knows? Maybe Rivian 3 to 5 years from now will be a fantastic company pumping out electric vehicles. I can't evaluate a company that doesn't have any revenue. So with a market cap currently of 28 billion, is that a steal? I don't know. Amazon's quarter was weaker, and their booming cloud business wasn't able to save the day. So everybody knows that Amazon doesn't really make money on Amazon.com, but their web services division is what is propping up the share price of the company. However, their cloud business grew at 37%, which was a slower rate of growth from last quarter. So even their good news basically had an overcast to it. So the numbers, the specific, Amazon posted a net loss of $3.8 billion when, obviously because of the Rivian deal, this screwed it up. We'll talk about their fundamentals aside from that stupid Rivian deal. But what is absolutely destroying Amazon today is their guidance for the next quarter, where they're only expecting to grow between 3 and 7%. This is with their booming Amazon Web Services division. You can't really call yourself a hyper-growth company if you're only expecting to grow maybe at 3%. So when we pull up the financial statements, this explains it all right here. Total net sales, they did $108 billion last year and $116 billion this quarter this year. So they increased their net sales by $8 billion. Okay, that's pretty good. But when you go down to total operating expenses, they went from 99.6 to 112.7. So for an additional $13 billion in spending, they only brought in an additional $8 billion. They spent 13 additional, only increased their total sales by $8 billion. This is a disaster, and this is showing that inflation is really hurting Amazon. The cost of their warehouses, the cost of their employees. In addition, why didn't they raise prices to keep up with inflation? Maybe they think that would hurt consumer demand, and then people wouldn't be buying as much. So Amazon has a problem, and Amazon really is the bellwether concerning all companies having issues with their costs of labor and their costs of materials. When we go on macrotrends.net, you evaluate Amazon because well, let's actually flip down to this sheet here, and I can show you the breakdown here. So this is net sales in North America, international, and AWS. And operating income, they lost 1.5 billion on selling stuff on Amazon.com. They lost 1.2 billion international. And the only thing that made money was Amazon Web Services at 6.5. This is the good news of Amazon in general. Operating income, they increased it year over year from 4.1 to 6.5. So that's the high margin money-making side of Amazon. And because their main business loses money, you have to evaluate them on price to sales. Currently, their price to sales is 3, but Macro Trends hasn't updated yet. Factor in a 10% drop. So their price to sales now is probably going to be closer to 2.7. Their price to sales during, obviously, 2020, when all the mega caps got inflated, was high as 4.6. And as their sales continue to increase and the stock price just trades sideways, the ratio goes down, which is good news potentially to attract buyers. The problem with Amazon, I think, is their disastrous technicals. This company has seen no share price appreciation basically in 2 years. And this the stock chart is just now a minefield of levels of resistance. So the all-time high for this stock, there's a level of resistance at 3,800. I think there's a pretty strong one here at 3,600. There's an intermediate one here at 3,200. And this level of support at 2,800, oh God, I hoped that it would hold. It did not hold on this weak guidance. So now it's falling, and more than likely it's going to fall to 2,400, or I guess it's fallen to 2,500. There's probably going to be more selling next week as people just want to maybe get out of this stock and find other deals. There's a lot of people who have bought Amazon in the last 2 years, and they're incredibly frustrated and disappointed with their investment, and they would rather just dump it and move on. So this is going to put a lot of selling pressure on Amazon in the short term. This stock, worst case scenario, it could hit 2,200 or more than likely 2,000, just a nice round number. Something interesting though is in previous videos, I did draw on this longer term slope line going all the way back to February of 2016. And it kind of looks like Amazon wants to touch it. Amazon wants to fall to this slope line, which would be at around 2,300. When we check in with my Schwab portfolio, it's an absolute disaster. When we look at the debit spread I bought on Amazon, the strikes are between 3,100 and 3,200. This is going to expire in September. I think I'm giving it a 0% chance of Amazon getting above 3,200. So back to here, back above here by September, because they're expecting another bad quarterly earning report next quarter. Something I'm considering doing with this debit spread is to wait to watch it, wait for it to bottom out, wait for it to fall, then buy back my short leg. So my long leg is worth 5,600, my short leg is worth 4,300. If I just let it keep falling, because the value is only about $1,000 now, if I just let it keep falling and then I buy back the short leg, if we can get a bounce in Amazon for a couple days, I might be able to get back another couple $1,000 before just closing this spread and giving up on it. Google, I'm not giving up on. I'm a bit more positive about their earnings reports and their share buyback. I think Google will rebound nicely and I can still make money on this debit spread. But with Amazon, this was a disappointment. This was a dud. Let's now talk about the problem that I think that investors have right now, in that people are rich. People have money and they want to invest and they don't know where to put their money. If you weren't aware of this, the S&P number is an aggregate of the combined market cap of the S&P 500. So this number stands for $41,780 billion. So when the market peaked back in January at 47.93 for the S&P, that stands for $47 billion. And the market has fallen to S&P value of 41. So where I'm going with this is that $6 trillion that has left the market. And where has that $6 trillion gone? People have to be doing something with it because inflation is bad, cash is bad. And you can only put so much money in the winning stocks so far this year. You think about energy companies like Chevron, up 33%, materials companies like Nucor Steel, up 37%, defense contractors, Lockheed Martin, up 23%. There are stocks, since the market peaked and has declined into a bear market, there are stocks that are up. The problem is the market cap of Lockheed Martin is $116 billion, Nucor is $41 billion, Chevron's pretty big, $313 billion. So if Amazon sold off 14% today and the market cap went down from 1.5 trillion to 1.2, it dropped by an entire valuation of Chevron. That's a lot of money, a lot of cash sitting in people's brokerage accounts, and they have to redeploy it. However, you can't keep putting money into Chevron or Nucor or Lockheed Martin because then these stocks get overvalued. So for everybody that sold Amazon today, where's that money going? And my argument is that Wall Street has a very short memory, short attention span, and at the end of the day, they don't really care about valuations as long as they're making money. So I think the mega caps, Apple, Microsoft, Google, Facebook, Tesla, I think people are spooked by earnings season this week, but in 2 weeks, 3 weeks, whatever, they're just going to go back to it. And then we're going to repeat this cycle in 3 months when we have earnings season again. So I think a bounce is coming. I'm actually feeling more confident about my disastrous options plays in portfolio currently. And if I just don't sell at the bottom and I hold for another couple of weeks, I think the money is going to start flowing back in and plugging these gaps because there's just nowhere else to go with it. You can always buy 10-year treasury bonds, currently earning you 2.8% a year. But when inflation is 9%, I think these large money managers, these large funds are just going to have to put it back in equities. Okay, everyone, that's all for this update video. If you found it informative, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.